Hi there, welcome to Market Call. It's Andrew Moffs of Vision Capital on our show today, and he'll take your calls, your emails and your tweets on real estate stocks. The number to call, 1-855-326-6266, or email Andrew right now, marketcall@bnnbloomberg.ca. Andrew, great to see you. I know I always ask you this, but you're okay with real estate equities, REITs, the full gamut?
The full gamut.
Okay. Tell us, real estate, obviously it's a big topic, but these low interest rates obviously making real estate looking attractive. It's easy to carry anyway in terms of debt costs.
Oh, absolutely. I mean, one stat I like to think about is the average cap rate for assets. So in real estate terms, a cap rate is the going in yield when you purchase something. So I'd say for the past 3 years, the average cap rate in the United States, just to give a metric, was 5.5% for, we'll call it the major food groups, retail, office, industrial, et cetera. 5.5 versus a U.S. 10-year Treasury rate of, call 2.7%. So a decent spread, healthy along the lines of average spreads over time. Well, we've seen the 10-year U.S. Treasury rate drop. It's now called 95 basis points today. That widening of the spread is really attractive. And so that valuation metric is something we're very focused in on at Vision. I'll give one example. If you're in the apartment space, if you buy apartments today in the United States, for example, or even here in Canada, they're more expensive today than they were pre-COVID. I mean, in the past 6 months, you've seen interest rates, financing rates for apartments go lower by 100 basis points. So yes, interest rate savings is a big deal.
So you said that prices for apartment blocks have gone up since COVID?
Yeah. In certain markets, you think about the U.S. Sunbelt, for example, where population is moving to. I wouldn't say that about places like San Francisco or New York, the West Coast, the East Coast.
Okay.
Those high tax centers where, with work from home, you can now work anywhere. But yeah, definitely here in Toronto, we've seen a record low cap rates in Midtown Toronto. So that trend is continuing.
What about retail real estate? Is there a feeling of dread in that sector right now?
I'd say this, if you think about the trends prior to the pandemic, we were already seeing e-commerce sales as a percent of retail sales increasing. That trend is not reversing. All the pandemic did was increase that penetration. So if you have brick and mortar retail, you have to think, how can this retail survive? If you have a defensive portfolio where you are leased to grocery and drug, pharmacy, you're in better shape. But there's a lot of space on the market. So, yesterday's news was great news in terms of Pfizer and the efficacy of their potential vaccine. It's not going to be enough to change the valuation of retail, we think, longer term. So you have to be very thoughtful about the type of retail you're buying today.
That's interesting. And just finally on office REITs, I know we're going to touch on that, but office REITs, a lot of jitters there too?
Absolutely. I mean, again, pre-pandemic, we were already seeing users use less and less space. Pretty much they were putting more and more employees into the same amount of space. Today, with work from home, it's far be it from me to pontificate and say what the future will hold for work from home and what percent of companies will adopt that. But no doubt there's been a change in behavior. And as soon as you see a change in behavior, you see a change in demand. So there's going to be different secular forces that are going to change the demand for office space. And we just think it's going to continue to be challenged. And it was already challenged going into this. So you need to have modern space that will attract the talent for those companies that will look to consolidate their headquarters and attract young talent. But overall, I think the demand for office space will be less over the next, for sure, over the medium term.
We're going to leave it there. Andrew Moffs of Vision Capital is taking your questions on real estate. We'll be right back. Nancy has sent us an email. She's asking about Allied Properties. Would you be a buyer now of this office-focused REIT?
I think it's still early. As I mentioned at the top of the show, we're seeing a change in the demand for office space. Allied has benefited tremendously from a very tight Toronto GTA office market. I think the dynamics are going to change looking forward. There was already a lot of new space coming online that's going to be competitive to the space that Allied provides. And then if you look at their clientele, you look at the tenants that have been leasing space, for example, Shopify, Shopify publicly has said that they don't need brick and mortar space. Now, I don't necessarily believe that will be the case. I don't think Allied is at risk. However, that is one of their largest tenants, and those trends could affect them. And it might have a dampening on the asking rates for space in the future. The second thing I'd say is Allied really has a great density story. They have a lot of excess capacity to build. However, if you're going into a weaker office market, that timeline's been pushed out. So we think the value, maybe over the very long term, is still there, but in the short term, we would steer clear of owning Allied today.
Now, they specialize, obviously, in these. They're amazing. I mean, I love what they do. As opposed to ripping down buildings, they convert old ones. That's their signature process into often offices for tech companies or creative companies, ad agencies. Those tech companies and creative companies, I wonder, are they particularly vulnerable, though, or particularly prone to switching their workers to working from home indefinitely?
Well, so that's the thing with tech. What you find with tech companies, they hire a younger workforce. That younger workforce is looking for benefits. A great benefit to provide your employees is something like a flexible work week. It doesn't cost you much. In fact, you save money by having less space. And then if the irony is some of these tech companies, they have to eat their own cooking. So if their business is predicated on the cloud, take a company like Dropbox. If they say, hey, we can provide a product where you can work from anywhere, well, why don't their employees work from anywhere? So I think that's something that's going to be a bit of a headwind for a company like Allied that, to your point, has great space. The brick and beam sector is a really great niche within office, and we like it a lot, and we think management's very good. But you can't deny the market forces.
Okay. We have Stephen calling from Calgary. Go ahead, Stephen.
Yes. Hi there, Andy. First-rate show.
Hey.
Andrew, how has InterRent performed with respect to apartment rent collections during COVID? I see they increased their distribution a tiny bit a couple of days ago. And also, I'm wondering if you're aware if Boardwalk has ever considered expanding into central and eastern Canada and being a national landlord, as net asset values for InterRent, Minto, and Killam appear to be pretty well below their net asset values. Thanks.
Thanks.
Okay, great. So two questions there. First, I'll focus on InterRent. InterRent reported yesterday, so we got a real-time answer to your question. Rent collections have been strong. All the apartment REITs in Canada have reported very strong rent collections, so we're pleased to see that. Where InterRent has taken a strategy, their focus today is preserving rent. So they're willing to sacrifice some occupancy to preserve that level of rent, as we're seeing a bit of turnover. Where InterRent has some weakness in their portfolio is in cities like Montreal, where they have a bit of a portfolio that's a bit concentrated on student housing. And as a result of the inability of foreign students to come to Canada, they've seen occupancy suffer. We think this is short term. We like InterRent. If you own it, I would definitely hold on to it. Great management team, and with a focus on Ontario, 2021 with the rent freeze in Ontario, you're not necessarily going to see the growth other than a mark to market in rents, which will be healthy. But beyond that, we think there's long-term value in InterRent, so I would continue to own that. Boardwalk's a different story. They're focused on Western Canada. Yes, they have expanded already outside of Western Canada. They own a portfolio in Montreal and Nuns Island, for example. They own assets in Ontario as well. But really, the driving force for that company has been Alberta. And with Alberta has been challenges. So as a result, their unit price is quite a bit below net asset value. So I don't see them expanding anytime soon, given their cost of capital is a bit prohibitive.
Yeah, certainly InterRent, pretty impressive the way their rents have held up. They've collected more than 99% of their July, August and September residential rents. And the current trend for October and November apparently in line with that. So certainly their rent rolls holding up there. Joe in Vancouver, go ahead, please.
Hi there. Good morning, gentlemen. Andrew, I'm just looking at XRE here. I do own the ETF, and it is a significant portion of my portfolio. I am comfortable having the Canadian REITs held in my portfolio as I'm looking for income. However, I was just wondering your thoughts on the fund and where I can diversify out of Canada from here. Thank you so much.
So, as a question as it relates to the XRE, it's always a good choice if you're looking just for a broad exposure to Canadian real estate. The one thing I'd say is, it is dominated by certain names. To the positive, a name like Canadian Apartment REIT is the largest exposure in that ETF, and it's one of our top picks. So I think you're well covered there. But at the same time, you then have exposure to companies like H&R REIT or RioCan REIT. RioCan we're actually now positive on in terms of the pricing of that security. But you might be better off picking some names specifically, and as we go through the show, some names where you see better growth ahead. In terms of expanding beyond the XRE outside of Canada, you have options. If you're looking at the ETF route, you can look at the VNQ or the IYR in the United States. Those are two US ETFs that are broadly based on the US REIT market. The US REIT market differs from the Canadian REIT market as there are many specialized sectors. So, for example, you see a higher weighting to things like towers, data centers, infrastructure, basically, that doesn't exist here in Canada in the US REIT index that really dominates that index.
Okay. Thanks very much indeed for that question. Andrew Moffs of Vision Capital is our guest today on Market Call. Real estate is on the menu, 1-855-326-6266. Dave in Toronto, fire ahead, please.
Hi, thank you for taking my call. I wanted to ask about Crown Castle. This is a company that has 5G towers in America, and I think they're a pretty good play right now because it's a pretty good discount compared to American Tower. And I think Elliott Management is involved in the company as well. And so I wanted to ask Andrew what he thought of the company as a long-term play for 5G. And I think it's a good hold long-term. So would you buy here, or would you kind of wait for a little bit more of a dip? Thank you.
Sure. So Crown Castle is one of the largest REITs in the United States. It's focused on tower and infrastructure assets. The tower business is a great business. Any business is predicated on the fundamentals of demand versus supply. Supply is pretty finite. You have just a certain amount of towers. You have an oligopoly in the space, so they're well positioned in that respect. Demand is going through a bit of a change. We've seen mergers on the tenant side with T-Mobile, Sprint, and thus you're seeing a bit of churn in terms of what the tower companies are, in terms of who their tenants are. And the rollout of 5G is going to be very significant. So I think you're right. There is a nice longer-term story here in terms of the rollout of 5G for these REITs. And so I think if you own the stocks like Crown Castle, you're in a good spot. Crown Castle specifically has been a perennial underperformer, hence there's activism in the stock. American Tower is the leader in the space in terms of returns, in terms of their strategy. Crown Castle has diverged a bit in their strategy. They don't focus solely on towers, and I think that's something Elliott wants to change. I can't handicap how that will resolve itself. I think you are in a good spot owning the stock. If you like the space and you don't want to take the risk, American Tower is a good choice as well. I think you're going to have a near term. I think you will might continue to see a pullback. These stocks are caught up in their rotation trade from tech into value, and these stocks have been winners throughout the pandemic. So you might see a near-term sell-off. That might be your opportunity to buy some more.
Peter in Vancouver, go ahead, please.
Thank you for taking my call. As usual, great show,
Pleasure.
great host Andy, and great guest Andrew, the best REIT manager. Please, may I have your expert opinion on European residential? That's ERE.UN. Thank you kindly.
Thank you.
Thank you. So yes, ERE, that's a holding in our fund. We think very highly of this REIT. We think it is a great value with a nice yield along the way as well. It is focused solely on apartments in the Netherlands. It's managed by CapREIT here in Canada. So they have really great management. They're focused on a niche, basically that is buying up mom and pop operators in the Netherlands and solidifying themselves as the largest landlord of apartments in the Netherlands. The Netherlands is one of the most dense countries in Europe. That's a good thing when you own apartment buildings. And we like how they're positioned. There's a significant mark-to-market in rents. They have a bit of a rent control regime that's similar to what we have here in Ontario, and ERE is very good at navigating that system. And what we've seen over time is that same store NOI, the operating income from this portfolio, has seen nice 3-4% growth over time. That's something we like to see in the companies we invest in, is growth, and they can both grow internally as well as acquisitions that I referenced to. So definitely a top holding for us.
Okay, we have Robert calling from London, Ontario. Robert, you're on the air.
Oh, hi. I'd like to get Andrew's opinion on Alexandria real estate. I took a position in April, and it's been kind of flat, so I'm just wondering if it's still a hold, and if not, if you could maybe recommend another REIT.
So, Alexandria Real Estate Equities, we own that in our fund. It is focused on lab space and life science office properties in the United States. We think very highly of management. If you talk about niche sectors, this is it. We don't really like the office space generally. Commercial office is a tough business to be in. You have a lot of annual capital expenditures that you have to pay to maintain the life of your building, whether it's elevators, roofs, lobbies, common areas. And then every time your tenant leaves, you have to pay a lot of money just to keep the rents flat. Alexandria is very different. The life science space is all triple net, even quadruple net leases, meaning the tenant is liable for all those expenses I referenced. And then you think about the space that they're focused on biotech companies in key markets in the United States, think San Francisco, New York, et cetera, where they can really cluster. Cambridge, Massachusetts, another one, where they can cluster their assets and own a market, and then be able to garner premium rents for premium space for the types of users that you think about funding that has gone to the NIH. That's the body that funds many of the biotechs that are coming up with solutions to the pandemic. This is it. This is the type of real estate that will benefit from all that government funding in the United States that's going towards biotech and vaccines, et cetera. So that's why we own the stock, and we think there's a lot of value there.
Okay, we are going to take a break. We're going to have a look at the past picks from Andrew Moffs next. You're watching Market Call. Let's check out those past picks in real estate from Andrew Moff. And of course, fascinating times in real estate in that these low interest rates have lifted valuations. BSR REIT was his first idea. Andrew was on November 4th of last year. This one losing a bit of altitude, Andrew.
Yeah, this is a great example of the disconnect between the private market and the public market. As I mentioned, private market, the value of apartment buildings in the U.S. Sunbelt, like states of Texas, Dallas, Houston, Austin, the value of buildings are higher today than they were a year ago. This stock is lower today than it was a year ago. We continue to recommend buying BSR REIT. We think this is a great little company focused exclusively on apartments in the United States, listed exclusively in Canada. So a bit of a mismatch and arbitrage that we like to take advantage of at Vision. They are focused on affordable rents. and almost think of it as affordable housing for Americans in cities like Dallas, Texas, which is one of the fastest growing cities in the country. It trades at a wide discount to net asset value, as I've referenced, and we think management is top notch. We continue to hold the stock and think this is a great opportunity to buy given the dislocation in the market.
Americold Realty, this one down a bit over the period. Just remind us what they do, if you would, Andrew.
Absolutely. So Americold Realty, they're in a unique business. They focus on the refrigerated warehouse business. Certainly, think of it as an infrastructure asset, basically supplying and helping the food chain globally. So we think this is a very defensive asset class with growth, and that's pretty unique. Why is it unique? Because this company has a moat. They are, the largest publicly player in the space. It takes a lot of technology to run these assets. At the same time, the valuation, we think there's a mismatch in the valuation in the private markets. These types of buildings trade at a discount to industrial assets, plain vanilla industrial assets, whereas we see no reason why we think that discount's too wide, the spread is too wide, and we see no reason why this asset class shouldn't close the gap, and we're starting to see transactions trade with higher and higher premiums in this refrigerated warehouse space. Americold is a beneficiary of that. And, it's been very defensive throughout the pandemic. It's seen some volatility. The shares have gone higher than where they are today. So we continue to own this stock and recommend buying it here.
Now, as you know, this new virus co-developed by Pfizer, apparently the genetic material, according to Reuters, needs to be stored at vaccine. I beg your pardon. We have enough viruses, don't need a new one. No, the vaccine. It needs to be stored at temperatures of minus 70 degrees Celsius. Could that be a business opportunity for companies involved in the so-called cold chain, cold warehouse companies?
Absolutely. So that's one of the things about this business is, its focus is on food. Unless consumption increases, unless you or I eat more and more every year, you should expect steady demand. However, with population growth, that demand increases. What's neat about this business is, yes, you can have niche opportunities that exist, and vaccines is definitely one of them. I've toured, these warehouses. They are cold. You have to gear up if you're going into them. So yes, they could handle vaccines.
And then your final idea, Andrew, was Granite Reit, and this one, not a bad pop. Remind us what they do. What kind of property do they specialize in?
They specialize in industrial warehouse. Industrial warehouse has been the beneficiary of, call it the demise of brick and mortar retail. And the pandemic has only accelerated that trend as more and more people shop online. Granite has a portfolio in the U.S., they have a portfolio in Canada, they have a portfolio in Europe, well-diversified, modern logistics. We think this company is really well-positioned. I think back to the height of the pandemic in March and April, talking with management, and they had a belief that assets would be worth more out of the pandemic than coming into the pandemic. And they went out and raised equity to fund buying assets, and it was really the right choice. I think they have a great balance sheet to take advantage of any dislocation in the private markets. And we see upside in these shares. There's a nice mark to market on rents every time a tenant moves out in the industrial space. And we continue to own and recommend Granite.
Okay, we are going to take a break. Andrew Moffs of Vision Capital is taking your questions on real estate stocks, REITs, you name it. 1-855-326-6266. Justice is on the line from Calgary. Go ahead, please.
Hi, thanks for taking my call. I was just wondering, what are your thoughts on ticker symbol MAC? It recently ran up on the vaccine news, but I was just wondering, what are your thoughts on it long term? Thanks.
Thanks.
Yeah, so MAC, that's Macerich in the United States. They focus on Class A malls, enclosed retail centers. They have a focus in markets like California, Scottsdale, Arizona, and Tyson's Corner in Virginia. This is a very tough space. The mall space has almost been death by a thousand cuts, and we've all been waiting for the bankruptcies of the department stores. And the fear was, well, they would happen all at once. If they had happened slowly and you could take back a Sears box, you could create some value, redevelop the space into some higher and better use. The tough part about the mall business is that with the pandemic, all that space has come at once, and we're about to go into yet another bankruptcy season post-Christmas. I'd steer clear of the mall space. There's no reason to have to take the risk and jump into a space that has seen major declines in rents, and the prospects are not awe-inspiring. So if there's been a run-up in Macerich, I'd suggest taking money off the table and looking to reallocate elsewhere.
Okay, no problem. Not on your favorite list right now. Bill in Ottawa, go ahead, please.
Hi, Andy. Long-time viewer, first-time caller. So
excellent. Thank you.
My question is on Killam. They've been doing okay, but nothing great during COVID, and I'm just wondering if they're a candidate to do well once the vaccine comes out.
Yeah, I believe that. Okay, nothing great is probably pretty good in this market, in the real estate space, and that's why we like multifamily residential. They have been collecting all their rents. They're well positioned. They have a good management team. They have a good portfolio on the younger side for Canada, which is a good thing because the older your buildings, the more capex, the more free cash flow you have to spend. Yeah, Killam, not unlike other apartment REITs, will be well positioned once, and hopefully we have a better solution to the pandemic. And what will that mean? That'll mean higher rates of immigration, and the Canadian government is pushing for that. That is something high on their agenda to make sure that 250,000, 300,000 people return and come, that stat returns and people continue to come to Canada. When they come to Canada, they're looking for affordable housing options, and that's what the rental stock is. So I think Killam will be a beneficiary. Today, however, the stock is pretty fairly valued. It trades at a slight discount, and you have to be patient, which is fine. There's no risk there, so I'd continue to hold Killam.
Okay, no problem. We have Tim standing by in Vancouver. Go ahead, Tim, please.
Oh, hi, guys. Yeah, my question is on Granite Reit, and so anyways, this one, it seems to be a little bit puzzling for me because their holdings all seem to be top-tier locations and mostly in big markets, and they're paying a 9% monthly dividend. So it's like it doesn't really make sense to me that this stock trading at $28 pre-COVID is sitting at $16 now. I realize it should be maybe off a little bit because of the mall properties, but it sure seems to be hit awfully hard, and so seems to represent good value to me. I don't know what your thoughts are.
Yeah, I tend to agree with you. We do own RioCan now. It overshot to a level where we thought the stock was attractive. Basically, all the negatives out there about retail are well understood, certainly by us. And we thought the market was being overly punitive with the price of their units. So I think there's an opportunity to own the stock here. Do I think it's going back to levels where it was trading pre-COVID? I don't think so. It'll be a tougher slog to get there, but certainly there's a lot of a gap to close. What I like about RioCan is exactly what the caller said. They have done a very good job of refocusing their portfolio to the major markets in Canada and refocusing within those major markets to really the best nodes in those markets. And so as a result, They have a growing portfolio of where they've done intensification, where they're building high-rise, whether it's condo or multifamily rental units, and they've done so rather successfully. There were some doubts when they started on what was an ambitious program, and today they're into it and doing a fine job. So we would buy RioCan here. We think there's value.
Okay, you would buy it. What about the distribution? Are they going to cut us? You may have touched on that. That's the one. I was just trying to check the cash flow there. Will they cut their distribution, do you think?
That's a great question. I think there is a better chance than not that they do cut the distribution. They're not getting credit for it today. They're not covering it today. I don't think any retail landlord is covering their distribution today. That's pretty valuable cash flow that would be better off reinvested in the business. So I think there's quite a good possibility that the board of trustees decides that a distribution cut is prudent for that REIT.
Mm-hmm. And the yield, as you know, has gone up to about 9%, yeah, implying jitters. Andrew Moffs is our guest today on Market Call. He's taking your questions on real estate, REITs as well. 1-855-326-6266. Let's head to Markham, Ontario. Alex, go ahead, please.
Hey, good afternoon, guys. My question, similar to MAC that you mentioned earlier, is on Simon Property Group, SPG. And I'm just wondering, Andrew, what are your thoughts on the strategy of them pretty much buying out, I guess, parts of their tenants? I'll hang up and listen. Thank you.
Thank you.
Yes. So Simon Property Group is the largest mall owner in the United States. They also are the largest outlet center owner. They operate the premium outlet centers, as well. They have ownership in properties in Europe, as well as in a company called the Mills Group, where they have Mills assets across the United States. Similar to Macerich, they're in the mall space. That's a space we avoid. If I had to buy a mall company, I would buy Simon. That said, the current valuation of the REIT, when I look at the upside, downside, you probably have more downside than upside ahead, just in terms of a risk-reward ratio. The strategy of buying tenants has been successful so far. You control your destiny if, in terms of leases that get rejected and versus leases that stay in place. And you might have co-tenancy issues if those tenants go bankrupt. Co-tenancy issues meaning that other tenants can say, hey, look, this part of the mall has gone dark. I should have a rent reduction. And that's just a cascading effect on net operating income, which the REITs don't want. So it's a defensive measure. I don't think it's something they would do on a good day. So take that for what it's worth. And thus, we just tend to avoid this space. We think there's greater ways to make money in the public real estate space than making bets on the future of malls in the United States.
You mentioned dark malls. It's funny, some malls, I'm thinking of a few in Toronto, just seem to go from year after year to year after year with just empty stores, kind of half dead.
Mm-hmm. Yeah, it's too much space was built. And often what you find is the landlords may not own the department store. And so that department store has controls over the parking lots and that space. And so whereas they would like to get to the mall space, they can't. And they're just waiting for the demise of that department store to finally, get control of that real estate. So it's an odd sector in that sense that you don't always control your own destiny. Whereas you might have a weak operator, but you don't own the real estate. And it's challenging to then reinvent the property until you do.
Oh, that's interesting. Yeah, that's why they just let the situation drift. Hang on, I'm having a few computer problems here. Control room, could you tell me who's next, please? I think it's Stephen in Edmonton. Thanks, my computer was acting up there for a second. Go ahead, Stephen.
Hey, Andy, first time caller here.
Good stuff, thanks.
My question is on Summit Industrial REIT. I added some to my portfolio a few months back, and it's done pretty well. but it still makes up a pretty small position of my overall portfolio. So I was looking to add a little more to it, and I was just wondering if you think it still represents some good value here or not. I'll hang up and listen. Thanks.
Thanks,
good for you for buying Summit when you did. It's a good little company focused on industrial warehouse in Canada. Stock is now back at its highs, and we look at that company and we say, wow, this REIT actually trades at quite a big premium to its IFRS NAV. That's probably a signal you might want to trim as opposed to add at this point, and look for a better re-entry point later. They do from time to time issue equity. They've been quite acquisitive. They've done a very good job of doing so. And they did raise capital, I think, back a couple months ago in August. So might not be soon, but that might be an event as the stock drifts higher. There are better values out there in the industrial space. I certainly think you're better off investing in the industrial warehouse space. So, we talked earlier about Granite, symbol GRT. We think that's a good industrial REIT to own, but nothing wrong with Summit, but for the valuation today.
Okay, let's head to Chris in Hamilton. Go ahead, please.
Good afternoon. Thank you for taking my call. Unlike Andrew's view on Brookfield Property Partner, it seems to have done, rising quite a bit the last little while. I'm not sure why. And I noticed that I think one of the analysts have dropped their rating on the stock to just a market perform, and I just wondered what Andrew's view is, and if he held it, would he continue to hold it? Would he buy more? Because I just thought, it's sort of a hold strategy and wait to see what unfolds with, the real estate market in general, but they have Brookfield with deep pockets behind it to pay the dividends. Your thoughts, please.
Yeah. So Brookfield Property Partners, BPY, I'd say about 40% of their business is in the mall business. We've talked about Simon Property Group. Brookfield Properties bought a company called GGP. It's a direct competitor to Simon. That's a very tough space. Another 40% or so of their business is in trophy office buildings globally. Again, tough space. You think rent collections have been challenged. They've been challenged in the mall and the office space. Then call it 15-ish% of their portfolios in opportunistic investing, which they've done a really great job. The company is managed by Brookfield Asset Management, so the caller is right. There's deep pockets behind it, and that's your fail-safe when you own this stock, is that if it gets too low, that parent company will come in and try and buy stock. Today, I do agree with that downgrade that we saw from RBC the other day. I think it's had a tremendous run off the bottom. I would look to sell the units in BPY today and look to reallocate elsewhere because your upside downside scenario is not nearly as attractive as it was previously. And I guarantee if the stock sells off again, there'll be an opportunity for the parent company, Brookfield Asset Management, to buy more stock, and that's probably a good time to look to re-enter.
Okay, so not interesting you at the moment. We have got to take a break. We're going to have the top picks from Andrew Moffs after this. Let's get to that first top pick, and Andrew Moffs is going with BSR REIT again. You're sticking with this one, Andrew.
Yeah, absolutely. I mentioned valuation for apartments, and what was great about their earnings season that just occurred in the United States is you have several comps for BSR REIT, where these landlords in the U.S. Sunbelt were able to give real-time examples of where assets are trading. And so take Camden Property Trust. The CEO of that company said there isn't a single asset they've looked at where cap rates are higher than 4%. You take another landlord, MAA, Mid-America Communities. They said pricing for assets are higher today than they were pre-COVID. And then you take IRT, Independence Realty Trust. Their CEO said for their secondary and tertiary markets, they've been selling assets between 4 3/4 and 5.5% cap rates. Here we have BSR REIT trading at north of a 6% cap rate. We think that is far too wide and doesn't make any sense to us. They've done a great job operating throughout the pandemic, and we think this stock is very cheap. We look at it on a U.S. dollar basis. I wasn't clear before if we were showing the Canadian dollar basis. It trades in two lines, U.S. dollars and Canadian dollars. On a U.S. dollar basis, you're able to buy this at $10.50. And if I apply some of those cap rates to BSR Reit, I mean, this stock could be north of $15, $16, and you're getting a nice distribution yield along the way. So we continue to own this stock, and we think this is tremendous value. We've seen this movie before where U.S. assets trading in Canada don't get the appropriate valuation.
No problem. Yeah, we were showing actually the Canadian quote there before. Tricon Residential, player in U.S. Residential rentals.
Yeah, so similar theme. Tricon is our best idea at Vision. Simply put, this is a company focused, similar to BSR, on the middle market, on affordable rents in the United States. This company owns about 21,000 single-family homes that they rent out in the U.S. Sunbelt. They own a further 700 to 7,500 multifamily suites that they rent out in the U.S. Sunbelt and similar markets. And then they have a smaller land business where they develop single-family lots and sell them to home builders. We think this company is way too cheap. If you look at the dynamics of what's happened throughout the pandemic, you've seen a major tailwind for the single-family rental sector. You've seen people moving out of high-cost cities into suburbs. You've seen people looking to get out of high-rise into less dense areas where they can have a backyard, have a barbecue, et cetera, have a space in their home to work. And you get that all in a rental home for the price per square foot that's cheaper than a multifamily unit. So we think Tricon offers tremendous value to the residents, and hence we've seen cash flow growth there. And then when you comp this company against its U.S. peers, we think it's very cheap. So this is an $11.20 stock that easily has 50 to 80% upside if you apply the same valuation framework that its peers, American Homes for Rent and Invitation Homes have, as well as you apply the appropriate cap rate that its apartment peers have on its apartment portfolio. So we think upside ahead. One vote of confidence was Blackstone, world's largest real estate private equity fund, invested in Tricon in an exchangeable preferred offering, giving a big validation for the management team and the business model. Blackstone was a pioneer in this space. They co-led bringing Invitation Homes public, and they've since sold out of that REIT. They reinvested in Tricon. At Vision, we were able to invest alongside of them, and we think there's tremendous upside in Tricon. So we think highly of that company.
Your final idea, Canadian Apartment Properties REIT. Wow, about 45,000 Canadian apartment suites in their portfolio.
Yeah, so CapREIT is the largest multifamily owner in Canada, publicly traded player. They also have one of the largest manufactured housing portfolio in Canada, where they own the land and rent out the pad. And they also have interest in Ireland as well as in the Netherlands through IRES, which is publicly traded in Ireland, as well as ERES, which we talked about earlier, ERE, which is focused on the Netherlands. CapREIT reported last night and really reported tremendous results, where they indicated there's still a 20% mark-to-market in their portfolio. What has hurt the apartment business in Canada in the short term has been what I talked about earlier. There hasn't been any immigration, and as a result, you've seen a temporary weakness, and you've seen a rent freeze in Ontario. Those trends will reverse, and CapREIT is very well positioned. Then you look at the transaction market and you look at the financing market. CapREIT's able to finance their portfolio at very, very attractive rates, 100 basis points lower than they were a year ago. Meanwhile, we're seeing transactions occur, 2% cap rates in Midtown Toronto. You apply that to CapREIT, material upside. So we're very bullish today on CapREIT. We think this is a company that has always traded at a premium to net asset value, and your ability to buy today at a discount to net asset value is very rare. So we think there should be reallocation of funds into CapREIT as we see the effects of the pandemic subside. We we have a return to a more normal operating environment.
Andrew, thank you very much indeed for joining us. Andrew Moffs of Vision Capital joining us on Market Call.